De-risked? Really? Is America at risk from China's large debt holdings from US stocks? China's exposure to US bonds decreases. Probably the first thing that comes to mind for investors when they think about the financial markets is the stock market. However, the bond market is the larger, less showy twin of the equities market. One of the world's safest investment options, US Treasury bonds, and the cornerstone of the fixed income market. The Federal Reserve, China, Japan, and other large investors have seen a reduction in their respective holdings of US Treasury bonds in recent years, reflecting a shift in the market's buyers. The change may have a significant impact on the US economy. The reduction of holdings by major players, including China, Japan, and the Federal Reserve, is causing a substantial shift in the US Treasury market. Treasury prices and yields are varying as a result of this shift in the market's dynamic. Investors navigating the changing US Treasury market landscape must comprehend the actions of these major stakeholders. Driven by Treasury bonds, the US Treasury market is a major player in international finance. This market is changing as a result of shifts in purchasing habits, especially from large purchasers like the Federal Reserve, China, and Japan. Volatility has increased as a result of the shift in demand, as well as factors like quantitative tightening and the rise of domestic investors as major players. High Treasury yields, particularly the 10-year yield, have an effect on a number of industries, including equities and mortgages. In spite of this, bonds continue to be seen favorably since they provide steady returns, especially given the present yield levels. With over $33 trillion in outstanding bonds, US Treasury securities make up the largest government bond market globally. The yields on those assets act as global benchmark for interest rates, establishing the starting point for borrowing for a variety of purposes, such as corporate debt and borrowing by non-US governments dominated in dollars. Therefore, if there is trouble in the Treasury market, it may have repercussions for the global debt markets as well as the global economy as a whole. US public debt is used as a benchmark for pricing other riskier debt assets since it is commonly perceived as a risk-free asset. Newly issued corporate bond prices are often stated as a premium over US Treasury bonds. For instance, you would currently have to pay 1.6 percentage points more than the yield on 10 years US Treasury bonds, which is currently 4%, if you were a US firm with a BBB rating. The corporate bond would therefore yield 5.6%. The US government has a lot of outstanding debt that is coming due to needs and refinance it in addition to filling the hole left by deficit. A startling 85% of the Treasury debt issued in 2023 has maturities of hardly more than a year. The Congressional Budget Office creates a budget and economic outlook usually in January and updates it in August to determine how much debt to issue. The Treasury Borrowing Advisory Committee, which is made up of senior representatives from banks, broker-dealers, hedge funds, and insurance firms, meets quarterly with Treasury officials. After that, the committee reports to the Treasury Secretary with suggestions for issuing debt for the upcoming quarter, culminating in a table that includes a suggested finance schedule. The Department of Treasury then publishes a provisional auction schedule. Market players might then make plans based on their anticipated future supply. Auctions are used to sell new Treasury security. Intuitions put in bids specifying the lowest yield they will take. The Treasury then utilizes a Dutch auction to fill all bids, starting with the lowest yields and continuing until the entire auction amount is sold. This same ultimate yield is then given to each winning bidder. Since primary dealer serves as a middleman, indirect bidders must submit their order through them as they do not have accounts with the Treasury. A small number of banks and other financial organizations are required to participate in Treasury auctions as primary dealers. Primary dealers will ultimately purchase the entire auction if no other bidders appear. This might theoretically total up to $90 billion, but in March 2020, the Federal Reserve unveiled a financing initiative known as the Primary Dealer Credit Facility, which enables primary dealers to get loans secured by recently purchased Treasury securities. There is no cap on the amount borrowed, so there is no chance of an unsuccessful auction. Auctions of the US Treasury securities are guaranteed to succeed. In order to purchase any unsold securities, the Federal Reserve will lend an ultimate amount of money to private sector organizations. But the Federal Reserve does not insure against price risk. Should interest rates spike sharply higher, bonds value would plummet, resulting in losses for the financial institutions that own them. This effect was seen in March 2023, when losses on Treasury securities and other bonds that are often considered high-quality liquid assets caused Silicon Valley Bank to fail. The value of the world bond market was $133 trillion in 2022. Over the past 40 years, debt securities have expanded 7 times, making it one of the largest capital markets in the world. Sales of business and government debt in emerging nations and large economies are driving this growth. In the past 3 years, the Chinese bond market has expanded at an annual rate at 13%. The United States has the largest bond market in the world, valued at about $51 trillion. The bulk of the debt market was made up of government bonds, with over $26 trillion in outstanding securities. The interest paid by the federal government on this debt amounted to $532 billion in 2022. China comes in second with 16% of the total worldwide. The majority of its outstanding bonds are held by local commercial banks, with foreign ownership remaining relatively modest. The third largest debt market is in Japan. A significant portion of Japan's government bonds are owned by the central bank. As the central bank adjusted its yield curve control strategy, which was first implemented in 2016, ownership reached a record 50%. The goal of the program was to keep interest rates from dropping while also assisting in increasing inflation. It had to raise its rate in 2022 to boost demand and liquidity as bond investors started selling as inflation started to climb. The modification caused tremors in the financial markets. With a total debt of $4.4 trillion, France has the largest bond market in Europe, topping the UK by about $150 billion. Commercial banks are major participants in the bond markets, much like central banks are everywhere. As a matter of fact, among the top 3 purchasers of US government debt are commercial banks. This is due to the fact that interest-bearing securities are where commercial banks reinvest customer deposits. These frequently include US Treasury bonds, which are among the safest investments in the world and most liquid. Bond prices have decreased due to the inverse link between interest rates and inflation, which began in 2022. This has sparked concerns about the kind of bonds that banks actually own. Treasury bonds and other government securities totaling $4.2 trillion are held by commercial banks in the United States. These interests make up an average of over 24% of assets for major US banks. In 2023, they will account for 15% on average of small banks' assets. Due to rising interest rates, small banks have been selling their bonds since the middle of 2022. Increased interest rates might put additional pressure on the world's bond markets, which have grown quickly during a period of ultra-low interest rates and dovish monetary policy as they ripple through the banking system and the larger economy. Significant alterations are being implemented in the US Treasury market infrastructure by US security authorities. Their goal is to promote resilience and transparency in the over $26 trillion market, which influences the pricing of various assets and loans, but whose trading activity is opaque and has experienced significant disruptions. The trading infrastructure, operational guidelines, and disclosure requirements for the major private funds involved in the market will change as a result of regulations that will be gradually implemented over the next few years. Many of these hedge funds and high-frequency trading companies, which accounts for a sizable portion of Treasury trading activity, would have to register as dealers under the new rules, which would force them to maintain larger capital reserves as a safety net against losses and expose them to more regulatory scrutiny. Industry associations have reacted differently to the plans. While some are willing to adjust to the changing regulations governing Treasury trading, others are considering filing legal challenges. The guidelines the Commission is adopting today are intended to lessen these risks and avert future market disruptions by extending the benefits of central clearing to a greater number of Treasury transactions, including cash and repos. Transparency, counterparty risk, and market liquidity can all be improved via central clearing. Reduced counterparty risk during times of market stress can also boost liquidity by lowering the chance of delivery failures. That's all for today. If you liked this video, please give us a thumbs up. Make sure to subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comment section below. Also, spend some time watching other videos on the channel. Until next time, bye.